Good afternoon and welcome to the Global Interdependence Center's executive briefing. I'm Bill Kennedy. I'm the Vice Chair of Programming for the GIC. And on behalf of the GIC Board of Directors and our staff, let me welcome all of you this afternoon. We're delighted to have with us today Dr. Charles Evans, the President and CEO of the Federal Reserve Bank of Chicago. President Evans is the ninth leader of the Chicago Fed. He serves on the Federal Open Market Committee, the FOMC, and oversees the work of professionals in Chicago and Detroit who conduct economic research, supervise financial institutions, and provide payment services to commercial banks and the U.S. government. Before becoming president in 2007, Dr. Evans served as Director of Research and Senior Vice President, supervising the bank's research on monetary policy, banking, financial markets, and regional economic conditions. Prior to that, he was a vice president and senior economist with responsibility for macroeconomics in the Macroeconomic Research Group. His personal research has focused on measuring the effects of monetary policy on the U.S. economic activity, inflation, and financial market prices. President Evans is active in the civic community and serves in advisory and board roles at several organizations, including Rush University Medical Center, the Chicago Council on Global Affairs, Econ Illinois, and the Kellogg School of Management. He has taught at the University of Chicago, the University of Michigan, and the University of South Carolina. And Dr. Evans received a bachelor's degree in economics from the University of Virginia and a doctorate in economics from Carnegie Mellon University in Pittsburgh. President Evans, you've been a very long time friend of the GIC. You've spoken at several of our conferences and events in Mexico City and Frankfurt and Madrid, London and Jackson Hole, and now we get a chance to do it in a virtual event. Welcome to the executive briefing.
Oh, thanks very much, Bill. It's really a pleasure to join you today.
Great, thank you. So we have dozens of questions that have come in from our audience. Going through them, it looks like they're falling into three themes. Questions about economic outlook, monetary policy, and then financial markets. So maybe we can kick off by having you share with us your assessment of the current state of the U.S. economy, and then maybe we can move into the economic outlook.
Sure. So, the U.S. economy is in a, remarkably challenged situation. Obviously, we're in a recession after going through the longest expansion of the post-war period. The last few expansions have been quite long, and the fundamentals are really quite good. As recently as the end of 2019, then the novel coronavirus appeared, and it's just the pandemic risk has really been extraordinary. So the U.S. economy has been coming back from that March, April period where everyone was staying at home for whatever reason, either explicit guidance, restrictions from states, or there's actually quite a lot of evidence that consumers were getting very nervous even before those restrictions were put in place, and they were reducing their activities, and economic activity was turning down during that time. So we've sort of gotten through that, and now more businesses have opened up. It's been somewhat uneven. In my own state of Illinois, we've more recently moved to the more open posture, but that's in part because we had more virus cases and we were being very careful about that. One thing that has amazed me is the way that businesses have been able to respond to the circumstances. The manufacturing entities, which were deemed essential businesses, maintained operations pretty much from the outset of this, and most of them found very quickly safe operating procedures, testing their workers, distancing their workers. When they couldn't be distanced, they would put up plastic and plexiglass. Now other entities have had more challenges, obviously, food processing and the like. But manufacturing has done reasonably well in this environment, and the auto sector has certainly come back after a brief lull there. So sales are better in that regard. So in terms of assessing how the economy is doing, the economy's beginning to come back and everybody's learning how to do business better, but the challenges will continue to be on the retail side, where consumers are feeling comfortable or not going into certain establishments. Travel, leisure, hospitality are obviously under a lot of stress, and it's really only going to be getting on top of the virus control, wearing masks, reducing the risk, and getting it to the point where people feel comfortable. And we're currently in that situation in a number of states where it's not really a second wave, it's really the first wave, since they didn't experience the breakout as early. And so in states like Florida, Texas, Arizona, and other states, and California is seeing more virus outbreaks too. So it's really quite a challenge. I think that's what the economy is going to have to navigate for quite some time, actually.
And so does that leave you to think the outlook is, and I hate to use the alphabet soup, an L shape, a V shape, a W shape, a swoop? What's the assessment looking forward?
So it's really just a remarkably unusual period. And so, I've got an outlook, I've got a baseline outlook because we are charged with submitting economic projections as part of the FOMC summary of economic projections. And we, make some assessments of how the economy is going, like I just did. And then we sort of put together some projections. And so, like the median FOMC participant, I see the second half of this year much stronger. Obviously, the second quarter is going to come in at a very negative number, minus 30, 35%. It's really the unemployment rate that's probably a easier to assess indicator of how we're doing. The growth numbers are so large, even if next quarter's growth is 10 or 20%, it's quite a lot to keep track of. And so with the unemployment rate at 11.1% right now, things have come back a little more quickly on the labor side than I was guessing. We're still struggling to figure out whether or not that's just a timing that more states opened up, more workers were called back to businesses than we thought, but it's just the same number that we were sort of expecting over the next 3 or 4 months. Real question is, what's the momentum going to be in the second half? I think the continuing virus spread is likely to put a damper on consumer sentiment, keep it a little bit lower. Now, that's part of my baseline assessment, is that we're probably going to see some of these outbreaks. And that's another question, which is the outbreaks that we're seeing. I asked my staff this. We've got an assumption that we've got some outbreaks. Is this in line with that assumption, or is it more than what we were thinking? And I think it's still too early to say, but I'm looking at the end of this year for the unemployment rate to be like the median FOMC, 9.5%. And I think that next year with reasonable growth, that could be 6.5% unemployment, which is still a high number. That's usually sort of a recession kind of number, although we'll be seeing growth that'll certainly indicate that we're not in a recession. But I'll say that's my baseline. Now, the likelihood of that coming, it might only be 50%, because there are other scenarios that are also in play. That's part of your VW whoosh kind of thing, and it's kind of like a little bit of this, a little bit of that. I guess a W is sort of a little bit of that. If we have something closer to a second wave type of outbreak, I think that's going to mean the employment situation is going to struggle a lot more in 2021 and growth accordingly. So that's pretty troubling. And then when sometimes I'm talking with people and they kind of say that scenario might be almost as likely as that baseline that we're talking about, that's a lot of weight on the downside. So I'm worried about the downside risks. And I think that's how policy needs to be positioned to make sure that we can get through this in households and businesses as best they can during these adverse circumstances, where it's really important that people be allowed to maintain their safety to get on top of the virus control.
Understood. And I do want to get into the policy implications, but before we do that, maybe we can get your take on the longer term perspective. What's your expectation for trend growth? Any changes there as a result of the pandemic? We finished last year the U.S. economy was about $21 trillion in size. how long will it take for us to get back to that high water mark?
So I think given the second half recovery this year, but then continuing recovery in 2021, but it's going to be the case that the big downturn in the second quarter and the first quarter was so large, it's going to take a while before we get back to the previous peak. I mean, we're looking for that sometime in middle or late 2022. And that's just the previous peak. Obviously, we should have enjoyed trend growth beyond that. So it's possible that we'll be below trend growth and there will still be an output gap at that point. On the other hand, it's possible that structural impediments are going to mean that potential output actually declines during that time period. That doesn't give me any comfort whatsoever when talking with my staff and other economists that they say, oh, the output gap could easily be closed by that time. But that's not just because of good growth. It's also because lost trend growth that we're not going to get back for a while becomes structural. And I think that's something to be concerned about. Again, that's why I think it's very important to have the policies in place to help support the strongest economy and recovery we possibly can have.
So let's talk about policy, and we'll go sequentially on the calendar. Starting back in March, the FOMC very quickly cut the Fed funds rate to the 0 to 25 basis point range, effectively the lower bound. And since then, the committee, the FOMC, has said that it expects to maintain this target range until it's confident that the economy has weathered recent events and is on track to achieve maximum employment and the price stability goals. So it seems a little bit vague. And you talked a minute ago about the SEPs, the Summary of Economic Projections. If you look at them, they are suggesting at least all but two of your colleagues don't expect those circumstances to occur until the end of 2022, as you just said. So
Right.
Can you just talk a little bit about, what are the parameters that you were thinking about as to whether it's the end of 2022 or 2023, or is there a silver lining where things could improve faster? How do you think about that?
Well, so, one of the scenarios, I don't put a lot of weight on this scenario, but one of the scenarios that, could come about is that all of a sudden we figure out how to do business, how to contain the virus. Either there are therapeutics that make this a smaller risk if you come down with it, or the vaccine comes along much more quickly and is actually effective for a long period of time. Those could be cases where we have stronger growth and we get back to our previous business cycle peak sooner than what I said. So, I mean, that's in play. I don't put a lot of weight on that at the moment, but I'm hopeful, that it does play out that way. It's interesting. So I've been Fed president now for, well, it's coming on 13 years. And we had another recession, right, out of the gate when I started, 2007. 2008. This is a very different recession in the sense that it was very sharp. It was real. It's all about public safety, public health, and the virus. And the decline is just extraordinary. But on the possibility that we get this under control, the ramp back up to more normal growth could come much more quickly. Again, it's that public health situation. Whether or not that happens or else it lingers. And then that's the question is the unemployment rate going to hang up around 9% or something, or will it come down? Now that is reminiscent of the previous recovery and that time period where we had the unemployment rate go up to 10%. It was a financial crisis. Monetary policy could only do so much. It helped out quite a lot. And then fiscal policy, for one reason or another, back around 2011, they fought over the debt ceiling. There was more a period of austerity when it came to government spending, and monetary policy was called on to do more when interest rates were at zero, and we had to pull out a lot of what were then unconventional tools with asset purchases, and we did that for quite a long time. Same questions were being asked at that time. How long are you going to do this? How long are you going to buy asset purchases? When are you going to wind it down? When are you going to raise the funds rate? It all comes down to our dual mandate, maximum employment and price stability. And, when the unemployment rate is high, when it's well above what you think sustainable unemployment is, it's not really hard to figure out that we need to be providing accommodation. On top of that, when inflation is low, below our 2% objective, we said we should be hitting 2% back in January 2012 when we brought out the long run strategy and we said 2%. Well, we never really hit that for sustained during that entire cycle. We tried, but we didn't get it up. I think it's very important that we get inflation up to 2%. I'm looking for that to be a real problem over the next few years. We could easily be in the 1.5% range and below 2. All of these things point to continued accommodative monetary policy until you get inflation up to 2%. And then we're talking about a new strategy it's just sort of better articulating, when you really need to be providing accommodation and people understand that it's there for a long time, provide the information that's important for them to go, oh, I guess this is going to be past 2022. It could be like that. So we're working on that, but I do worry that if we don't get on top of the virus spread and control, that we might be dealing with more of those issues like we did not so long ago.
Understood. And I think getting control of the biological impact is going to be very important. And it then takes us to the conversation and the minutes from the June meeting where the FOMC said they thought once the economic picture becomes more clear, and maybe that's because of therapeutics or vaccine, the committee should provide more, do some more. And I think their idea there was provide more guidance, more forward guidance about the path for the funds rate going forward, more clarity regarding the intention of the asset purchases. Could you talk about that a little bit? And I want to talk about the concept of negative interest rates and yield curve control as well. But what more should we expect from the Fed from this point?
Right. So again, it sort of depends on the situation that we're facing. And so under sort of the baseline outlook that I have in mind, where the unemployment rate could be 6.5% at the end of 2021, that's higher than I think is a sustainable, unemployment rate. And I think inflation is going to be lower. So I would say that's a time where we need to continue to have accommodation. I think a good part of what policy is going to need to be thinking about is how much fiscal policy accommodation are we having. That's also, if there's a lot of fiscal policy response and if the virus public health response is better, you would expect the economy to get better and inflation would go up towards our target, maybe beyond. So I think, what other policies are going to be are very important, but I can't think of a good reason why we should provide anything other than strong accommodation when we're underrunning our 2% inflation objective. And even if unemployment goes lower, we definitely learned during this most recent recovery and expansion that the unemployment rate can go lower than 4%. It can go down to 3.5%. We didn't have inflation. And I think that was just a very good thing for a lot of people who were able to have better opportunities in the labor market, form stronger attachments to the labor market, and build skills in the time that they, had greater access to those market opportunities. Now, those have been lost, certainly set to the side. If we can put people back into the same positions quickly, which I think was the hope with the shutdown, and then kill the virus and bring people back, the longer that takes place, and with unemployment remaining high, then we need to actually find matches that are good and productive for people, and that's going to require a lot more work on everybody's part. I think fiscal policy, but also monetary policy. So I'm hard pressed to think of reasons why we would need to move away from accommodative monetary policy unless inflation was well above 2% for an extended period of time, and the economy is just very different than what we're seeing right now. That doesn't seem to be likely, in my book. And so it is right to ask, what are the accommodative monetary policies? I think that was where you were headed next, wasn't it?
Correct. Yeah, at both negative interest rates and yield curve control. Does the Fed really have to go that far?
So negative interest rates are interesting but tricky situation. During the 2008 recession and the slow recovery, we pulled out a lot of additional unconventional tools, but the committee never really considered negative rates for any extended period of time. As a theoretical matter, it always seemed kind of odd that you could actually charge negative interest rates. Well, because people can't just go into cash, you actually can, and banks are in that situation. And there are a lot of foreign central banks that have done this, and it's helped them, I would say, but they haven't been able to go very negative. And if you just sort of look at policy prescriptions that come out of interest rate rules during the downturn, they would have suggested that we should go negative on the order of -4, -5%. And there's nobody who thinks about doing anything like that. Somehow changing the incentives, it's all about providing incentives for banks to do even more lending than they're currently doing. I think that's a big part of getting the economy going again. So I think that our financial programs have been helpful. I think that ensuring that the banks have adequate capital. I know there are different judgments on potential losses that banks might be facing depending on how long this plays out. But after Dodd-Frank and with the current regulatory environment, banks in the U.S. have more and better capital. We've implemented stress tests, quite usefully. There are a lot of details, and we could argue over, you could do it this way or you could do it that way. But I think that, most recently we have put in place policies that have helped preserve more capital than we might have had before. And I think that's good for continued credit intermediation for households and businesses. It really needed in order to get through this time period. In terms of yield curve control, I'm still grappling with that, and I can see its potential use. I do think that I'm a big proponent of forward guidance. I think that our threshold forward guidance back in 2012 was a useful addition to the open-ended QE3 that we did. I just think a lot of this is convincing people in the markets and in the economy. The Fed is there to do what it takes to get the economy going, get inflation up, and we're going to continue to do it. That's the lesson I learned from the Bank of Japan not getting there, the ECB being slower. And so whatever policies convince people in the markets and the public that we're really in it to win it, that we're going to keep at it, I think that's what's most important. Yield curve control could help. But I think that if you go out and just every day sort of, beat the drum that, this is what we're going to do, we're looking for, and you put some markers down like we did with thresholds and the open-ended QE3, I think that that's extraordinarily useful.
Thank you for that. So the Fed has obviously implemented a variety of facilities, and they're all meant to support the flow of credit to the economy, and that's at the household level, for businesses of all size, for nonprofits, state and local governments. On the one hand, there are those who are concerned that the programs won't be effective, or they're not enough, or in combination with fiscal policy, it's not enough. And then on the other hand, there are those who claim that the Fed is being too proactive and too aggressive. And not just this year for the pandemic, but in terms of quantitative easing over the past decade. Can you just address that, and what are your views on that problem?
There are a lot of different dimensions to this question. I can start out even before, the coronavirus episode, which was that we were trying to figure out what the best size of the Fed's balance sheet was, because after QE3, the Fed balance sheet got up to $4.5 trillion. The asset size, reserves were very high. And then, it was always sort of stated that we'll bring it back down to something less than that. And then the question is less what, how much? And we sort of indicated that, we'd like to have an efficient size of the balance sheet. We would have discussions about, well, you could take the view that you want to provide a very abundant amount of reserves so that banks just don't have to think about that issue in financial markets, that it's relatively easy for them to have that very safe asset, and that supports financial market functioning. And then as we continued to reduce the size of the balance sheet, we ran into certain flare-ups around tax time, which didn't happen before. And so the size of the balance sheet looked like we were getting to, the part that was a little scarcer. Okay, so there's that issue. Um, um, so then you get into the downturn and you say, okay, well, this is a recession. Well, I guess one of the unexpected benefits of the great financial crisis was that Ben Bernanke and the rest of the Fed came up with these innovative liquidity programs that were on the shelf, and we could just quickly implement, dust them off, make sure that they're still appropriate. And so a big issue that came up was the money market funds, the prime funds that had some risk in them, and people wanting to move out of the money market funds, and then the banks would get called for their commercial paper, and so then people took out lines of credit, and so all of a sudden bank balance sheets started moving in directions that they weren't looking forward to, expecting. And so the commercial paper funding facility is very important. Supplier for that, money market mutual fund out of Boston is also very important. So those were things that had previously been thought through, and those helped find the proper support for a number of short-term financial markets. We did repos, getting at reserves. Now, as you start thinking about the particular circumstances we're facing with the coronavirus, where businesses are being shut down for whatever reason for 2 months, maybe 3 months, how do they make payroll? Good, solid fundamentals for so many businesses. All of a sudden, people could be facing bankruptcy because they just don't have that much liquidity on hand. Do they have to make their mortgage payment? What are the creditors going to do? And so I think these programs that tried to help get people over a 3 or 4 month period so that they could repay a loan. In other cases, Congress stepped up, the CARES Act, and they actually offered financial support for certain industries that were hit particularly hard. Also for households with $1,200, the generous unemployment insurance compensation with the extra $600, which helped households so that all of a sudden they can still make their rent and mortgage payments. And so that helped out. And we just had a number of programs that are sort of in the vicinity of that, but they're all, the term sheets, the pricing on these, the Fed can't do grants. We can only make loans. A lot of entities really need grants. And so our loans aren't exactly what they need, but they might help out. Most of our facilities are priced at not a particularly generous rate, unless circumstances are much worse, and then they are pretty attractive. And so that's kind of why we probably haven't gotten a lot of take up in some cases, but we're still rolling out programs.
So as those programs get rolled out, how do you respond to concerns that the Fed's aggressive policy stance is actually causing market pricing distortions, whether it be in credit markets or equity markets or other capital markets, and concerns that it is contributing to wealth inequality?
So first off, things like the Main Street lending facility, those are not capital market borrowers. Those are entities that are looking for bank loans, and we're working with banks. And a lot of times the banks are actually already willing to make those loans, and so the additional terms that we put on those loans, the banks kind of go, I'm willing to do this loan myself and take all of the upside. Then there's some other loans that are probably riskier, and it's not clear that those are the right loans. Then there's a sweet spot, and that's what that facility is kind of looking for. I don't really see a pricing distortion. I see entities being helped that are still creditworthy and provide value to their community and the economy going forward. We have definitely put together additional programs, the primary credit, the secondary credit programs where we're purchasing some corporate debt and some other things. I think that actually helps the market find the appropriate price as opposed to the distressed price. Our purchases just aren't that large to really distort the market, and when other entities are continuing to trade without the benefit of us actually showing up and whatnot, I think the market is working okay. I mean, I'd be happy to learn more about that and hear other viewpoints, but I think at the moment, those are useful programs. But this is always an issue Anytime we enter into a market other than pure treasuries, there is this element of you're here, but you're not in other places. I think we're very sensitive to it, and under normal circumstances. In the past, when we were unwinding our large balance sheet, we said we really want to move to treasuries only, even though we had a lot of MBS. And I think there's a sense in which you would like to do that. There's also a sense in which there's a crisis when you're practically on a wartime footing, as the president said at one point. It's like, we're just doing a lot in order to make sure we can get through this year, when the virus is, better under control.
So we have a number of questions regarding pricing distortions. We'll come back, but do you want to take a crack at the wealth inequality piece of that question?
Oh, yeah. Okay. Well, so it's certainly the case that equity markets have gone up. If it's the viewpoint that helping businesses avoid bankruptcy leads to a higher stock market and higher wealth, well, I think we're trying to support the fundamentals and not let a short-term crisis all of a sudden destroy value that then would be picked up in other circumstances by other people. Now, it is the case that interest rates are lower, and so the discounting factor for future earnings would suggest, higher valuations. There, I don't really think that we're not the primary factor there. There's been a long secular decline in interest rates around the world. It's been quite a large development, 200 basis points. I just saw a chart this morning where somebody was showing me, things like that. Rachel and Summers' estimate of how much lower neutral interest rates are. And so that's really a lot. That would tend to have implications for asset valuations just by themselves. And then there's monetary policy on top of that. I do think that when we're supporting the economy, when we're keeping businesses in place, they can hire employees. Employees can earn their wages, earn their salary, keep their houses. That's part of wealth creation. So I really worry that a lot of wealth would be destroyed if we didn't step in and help out. If we end up with a second wave where unemployment were to stay above 10% for an extended period of time, there'd be a lot of inequality. There already is too much inequality, but it would just, be moving in the other direction.
So looking ahead, maybe you can help the audience understand under what principles does the FOMC determine and measure when enough is enough? And right now it's pedal to the metal, very aggressive, accommodative policy. When does the FOMC take its foot off the gas, and what are the metrics or the principles that would lead to that decision?
It's a great question, and I would say that this is the question that we grappled with and talked about over the last many years as we were trying to get interest rate up off of zero. We finally increased interest rates in December of 2015, but it was a long period before we did that. At some level, I think it's actually very simple. We have a dual mandate. We're supposed to provide monetary and financial conditions to support maximum employment and price stability. Maximum employment, like I said, we learned during the last expansion what many other people have been telling us for a very long period of time. Unemployment can go lower. The labor market needs to be as strong as it can in order to support more people so that inequality would be reduced and wages could go up a little bit more, and that would help out too. The circumstances under which I, as a central banker, should think about leaning against a strong labor market, in my opinion, should be ones where inflation is somehow undesirably high, that it's at great risk because it is the central bank that is supposed to be providing price stability. So that dual mandate of maximum employment and price stability is really those are the markers. And we didn't even get inflation up to 2% sustainably during the last expansion when we said we were supposed to, and we were raising rates at the end. I thought we were going to get more inflation because the tax reform and fiscal package that the president and Congress passed was really something that should have, when unemployment was so low, you would have expected that really to kick the economy into a fifth gear, if you will. But then the tariff, and trade discussions, I think, create a lot of uncertainty. So that kind of got in the way of that. But at some level, it's simple. It's just articulating a position that people don't always see, which is, we need to get inflation up to 2%. 1.7 is not really good enough, especially when you've been under 2 for so long. You should actually be at like 2.5 for maybe a few years in order to average that out. And I think that's something that, the committee's been talking about one way or another. If not the 2.5, the sort of averaging over a long period of time.
Understood. President Evans, I'd like to go back to one thing you talked about just briefly, and I'd like to drill down just a bit. The FOMC was in the process of reviewing the long-run monetary policy framework, the strategic review of the Fed's policy, and then the pandemic hit. Can you talk about that strategic review? What's the status, and are there any features of a new strategy framework for the Fed that may be helpful in the current environment?
Sure. Yeah, no, I think, Chair Jay Powell showed tremendous leadership when early on in his tenure, he said, it's really good if central banks periodically stop and reassess their strategic framework. The Bank of Canada does this every 5 years. Other banks have done that. The Bank of England did it not too long ago. It was accompanied by what seemed like a brilliant suggestion that, when times are quiet and things are going pretty well, that's a good time to have these discussions. There's that saying that people make plans and God laughs. It was supposed to be quiet, and then we ended up with more crises than we were expecting. But the Fed embarked in 2019 on a year-long process where we had, I believe, 14 Fed listens meetings around the country, where each reserve bank got together with stakeholders, constituents, business people, households, communities, and listened to what was important in their world and what we should be thinking about. And I personally, I was moving around over a number of years towards, we need to be weighting, the employment mandate even more than, that 50-50. And you just heard a lot of very poignant stories from that. We had a academic style conference in Chicago in June of last year, where we had a lot of people make proposals about how we should go about doing this. And then we started thinking about, what does this mean for our long run statement, our consensus statement? And because that's where in January 2012, Ben Bernanke and the FOMC came out and said, we're going to target, we're going to aim for 2% PC inflation. We're going to tell you that we think maximum employment would be associated with the long run unemployment rate that the SEP participants point to there, which, could be, 4.5%, that type of thing. And we take a balanced approach to addressing imbalances like that. So we've had some discussions. We got to the circumstances where things got in the way, and we said, well, we're not going to make an announcement in January of 2020, but it's going to be like the middle of the year, hopefully. And now we're a little bit past that because of circumstances. So we're talking about this, and I think it's likely to be important as we talk about what's forward guidance likely to be for monetary policy in the current environment. I think updating our strategic approach and providing more information about that 2% information objective, how we think about maximum employment, how we think about when unemployment goes below what you think is the sustainable level of unemployment. Does that necessarily mean that you should start thinking that you're too accommodative? Well, look at inflation, I would say. And so we've had discussions about these, and I anticipate that before too long there will be some developments there, but that's for others to announce. You actually have to get there.
Great, thank you. Let's go to the financial markets, and then we have a host of audience questions we want to get to. So I was surprised to learn that the mighty 7th District of the Federal Reserve System actually has more banks than any other district. I guess that's the number of banks that are around. So you probably have a view on this question about commercial real estate and the exposure of CRE and commercial real estate in the banking system. Is that a concern? How do you think of that?
Yeah, that is right. The Seventh District has quite a wide array of financial institutions. We've got some very large institutions. We've got community banks, a very large number of community banks, that undoubtedly has a lot to do with that number that you're talking about. I think that if you think about sort of the evolution of banking and the challenges that sort of the barbell situation for banks, where you have a large number of large banks and you have an enormous number of small banks and not a lot in between. The community banks have struggled with finding the sweet spot of lending. In the old days, they could have local small manufacturers that could be bread and butter lending. There's way more competition from the larger banks on that. And so moving towards CRE is a natural thing over time, and that ends up being a little bit riskier depending on the circumstances. I think current circumstances are a risk that very few people could have imagined. I was talking to somebody in a completely different setting who said 7 months ago, nobody would have thought about the coronavirus putting us in the situation, where we are. At any rate, I would say that when people are asking, when are people going to start going back to work? People who are working remotely, office buildings. When are you going to go back and 100% occupancy for office buildings? If you choose not to do that, what's the leasing ability for those office space going to be? What are the loans going to look like? I think there's way more risk than anybody could have anticipated when the buildings were built. Look at hotels, travel, leisure, business travel. Disney World is opened, so we'll see how all these things play out. But I think there's a tremendous amount of uncertainty about how that plays out. One would guess that pricing would be affected, and occupancy and things like that. I do think that sometimes I talk with people and they kind of go, people are going to work from home going forward. Who wants to get on the train? In Chicago, you got to take public transportation by and large to get into town, or from your city location to that. I think by and large, we're going to move largely back to where we were before, but it's going to be a little bit different, a little bit more remote. Certainly the WeWork kind of occupied space, how's that work going forward? A lot of uncertainty. So I think there's risk. I think that was reflected in the most recent review of banks, and I think the banks are going to be asked to review their capital plans the rest of this year as part of that. Just the entire portfolios and risks that they're facing.
Okay, so let's go away from traditional banking and maybe talk about the risk associated with the shadow banking system, the derivatives markets. How do you think about those risk characteristics?
Shadow banking is very large and almost non-descriptive. You mentioned derivatives markets. Certainly, there are a lot of adjustments in derivatives markets after Dodd-Frank. There are many more contracts that are traded and cleared, traded on exchanges and centrally cleared. And I think that helps out with a lot of the resolution issues when prices move in an unfortunate way, and then some participants can't make their payments, can't make the variation margin. Now they can on the exchanges and things like that. So I think the risk has been better contained. Now it's all sort of put in one place, and so that's why making sure that is well controlled, risk controlled and managed is very important. Lending that takes place outside of banks, obviously, that has expanded. Banks are regulated entities. Other lending is not necessarily regulated, and so that does have the possibility that other types of pricing and behaviors could be taking place. A lot of times it's also very costly financing for small businesses, might be very short term. as well. And so that can be lucrative, but it can also, dry up and disappear very quickly. So, I mean, I think that's something that we all have to be mindful of and paying attention to. But if we're kind of talking about lending that's not leveraged, it's really leverage that gets in the way of all of this. If it's a financial institution, an investment firm that is somehow taking their funding and lending it out, if they lose it, if there are no multiples on that, that's just an investment that didn't pan out, and there are many other investments that do pan out. And so I never like the idea of sort of looking overly carefully at various positions or whatnot, because people they're going to be winners, they're going to be losers. That's what capitalism is about. And it's also about when you win, you get to keep it and keep going, and when you lose and you take your losses and something, and you go home, that type of thing. So to the extent that it doesn't cause larger problems through leverage lending and then not paying off, that can be all right. But it really depends on a lot of details. Shadow banking is so broad. If you talk about particular types of entities, it might have sharper consequences.
Thank you for that. So we have about 10 minutes left. I want to make sure we can get through some of our questions from audience attendees. There's a question: how important is underemployment going to be? So we've spoken about the unemployment rate, but what about underemployment? How important, how much focus is the Fed putting on that construct?
Well, I think the issue is very important. I mean, I think that, again, it sort of depends on how large this question is, because, a lot of it comes down to people having good jobs, matching, for good employment opportunities and being paid well, getting the hours that they want. So, I mean, underemployment obviously was an enormous problem during the, slow recovery, after the great financial crisis. Unemployment was very high. U6 was much higher. Long-term unemployment was much higher. It became stigmatized for people who had not had a job for a long period of time. It was that much harder for them to find a job. People who had part-time jobs, they often didn't have schedules that worked with their situation, and with childcare and all the other issues, which are even more paramount now in the current virus containment, problem. So I think underemployment is always important. From a Fed perspective, I think a lot of this comes down to, we just need the strongest economy we can get to without inflation going off into a direction which is unacceptable. And like I say, I think inflation has underperformed for quite a long time, and so inflation above 2% would be quite appropriate for some period of time, even if unemployment's very low. That would be a good thing. We've also spent more time at the Fed, talking to broader parts of the community, trying to get at the idea that more people should be sharing in the recovery. We need an equitable recovery as we go forward. This gets at the inequality issue that you raised in a different context. I think it's very important if we could help reduce inequality so that more people could definitely share in the gains here. And so I think that just means for the Fed, it's very narrow what we can do, but I would say it's let's try to support the strongest fundamentals we can.
Thank you. So this question is regarding the path of inflation, and the question is, what lessons has the Fed learned from the 2008-09 experience that may apply today, and with regard to the path of inflation?
Well, I can tell you what I've learned, which is getting inflation up is a lot harder than anybody ever thought. Certainly when I was a student of monetary economics, where you kind of thought, just print a little bit of money and you're going to get too much inflation. The problems that we had in the 70s are not the problems that we have now. And with interest rates moving down on a secular basis around the world as low as they have, there's not a lot of monetary ammunition. If you marry that with an environment of fiscal austerity, there's even fewer reasons why prices are going to move up. So I would say the lesson that I've learned from this is when interest rates are low, when you're at the effective lower bound, and inflation is just underrunning, you need to work really hard to get inflation up. And I'm really somewhat enamored with an idea that Ethan Harris has been an advisor to the Chicago Fed, and he articulated this view. Others have too. But I would say, sort of like, if you think about an economic cycle and you break it up into two phases, in the first phase where inflation is well below your target, you work like heck to get it up to 2%. And I would be perfectly happy to have it go up steeply with a steep trajectory to 2% to make sure that you get to 2%, because when you try to sort of asymptote in, there have been too many times we've been disappointed. For the first half, you try to get it to 2%. Then after that, you try to maintain it above 2%. Oh, not really high above it, but enough so that you sort of average. And then if you average 2%, that would be a pretty, reasonable accomplishment, I would say. We've done none of that. Since the 2012 long run statement. I would say that we always had the best intentions. We always thought that we were providing accommodation, but I've learned that we often didn't have nearly as much accommodation as many of us thought. We just need to work harder.
Thank you. So there's a question here. The US Treasury is issuing trillions of dollars of debt. The Fed is buying trillions of dollars of this debt. How can these transactions be seen as, quote, independent? And shouldn't they be at least coordinated?
It's a fair question. I would say that this is why the long run monetary policy strategy is so important. I think it's very important to describe how we're going about meeting our dual mandate responsibilities, maximum employment, price stability. When we provide a few more details about what we mean by price stability and what we're trying to achieve, that has often led to the implication we need more accommodation. When interest rates are at zero, how do you provide more accommodation? If you allow yourself the out where you go, I'll go down to zero, but I won't do anything more, you won't meet your dual mandate responsibilities. So the strategy is important. Once we start buying assets, then we're buying treasuries because those are the safest assets, and that is what the federal government right now is running large deficits in order to protect the American people, and we are part of that. Articulating the path forward for the Fed and our balance sheet is also important, and so that's why our discussions about how are we going to unwind the size of our balance sheet, what's the appropriate size of the balance sheet, the more we clarify how that factors into what we're doing, then I would hope that the public and people in the markets would say, oh, I understand what they're doing. Is it aligned with what the Treasury's doing? Well, they're both trying to achieve a good outcome for the economy, so that doesn't bother me. If we're aligned for a nefarious purpose, and you would evaluate that on the basis of, well, the Fed says they're trying to do this and they haven't. I think that's how I would go about thinking about it. So I think communicating is just really, really important here.
Thank you. So the Global Interdependence Center, obviously interdependence is our middle name. We spent this entire series since March talking about positive interdependencies and negative interdependencies. This question has to get to how would you describe the connectivity and the communication and the interdependency between the Federal Reserve System and other central banks around the world? Has it been a positive interdependency or a negative?
So that's a great question. I would say that it's been a positive interdependency, over the last many years, going back to the previous great financial crisis. I would say that without coordinating activities, there's always been a lot of sharing of information. Everybody tried to understand what their strategies were, and as best you could, you would be all aiming for, a good global economic outcome. Now there were always times where, and you would get this, comment from emerging market, economies during times when we were doing QE2, and that was very unpopular. And then there were times when we were unwinding the balance sheet, and that was viewed as unpopular, sometimes by the very same people. And so sometimes, economies are in slightly different positions. But I'd say that there's a lot of sharing of information among the G20, the central bankers and those who go to Basel and all of that. I think that was very important during the previous recovery. I think it's going to be, it probably has been important during the current time period, but at the moment, it's so much about the public health safety. It's all about getting on top of the virus spread. The situation in the United States, really, we need to get to a point where everybody can feel safe going out and about, going to their local stores, whether it's in Chicago or Fort Lauderdale or Columbus, Georgia, or wherever, San Francisco. And what's needed in order to make sure that people are protected, we get on top of the virus until a therapeutic or a vaccine. Conversations with central banks are very important, but you gotta do your homework at home first, and then we can see how it's all playing out. Those are very important conversations, but at the moment, this is really a real event. Monetary policy is trying to make sure that the markets are continuing to function well, credit intermediation is taking place, and as best we can, provide commentary of support for everybody else who is also aligned with achieving the strongest economy possible.
Great, thank you for that. The question is, how will the Fed pull back from increased liquidity without sending capital markets into turmoil?
So we've sort of indicated that most of our lending programs have a certain, date, for while we will be, engaging in those activities. Depending on circumstances, it wouldn't be unusual to perhaps extend dates a little bit. But I think at some point we're going to get to the situation before too long, I think. Although we've just started some of these activities, we're going to get to the point where we're not actually doing purchases, but we're going to have assets on our balance sheet that have some duration, and it's going to take a while for them to roll off. But at that point, I think there's going to be a natural maturity where they will roll off, and the larger question is going to be, what's the size of the balance sheet that the Fed wants? How does that fit with financial market activity? It would be more like the time period from 2016, in the aftermath of how we manage that. So I think some of these programs, it's a little too strong to say they're self-liquidating, but there is a period where we're not going to continue to add to them, and then they're going to mature, and how that plays out with financial markets and all of that, we'll have to see.
Thank you. Question, there's actually 2 or 3 questions here. I'll try to combine them. What's the Fed doing to support nonprofit organizations and municipalities? And is the Fed seeing distress in either of those segments of the U.S. economy? So clearly for nonprofits, you could see the potential, but is there distress being found on the municipal side as well?
Well, we have a municipal lending facility where I forget exactly, several $100 billion are available for the 50 states and municipalities and large counties to come and borrow from. The terms are, like I said, with some of these, other programs, they're kind of priced so that it's not fire sale pricing. It's not, it's not in our, wheelhouse. We're not allowed to provide grants. We can only do this lending when somebody like the Treasury has a first loss position here also. We're not supposed to lose money, but we can provide the liquidity. So the pricing on this is not the most attractive, but it is attractive to some. My own state of Illinois is already gone and taking out a loan in order to smooth out some of their financing. But I think other states look at this and they find it not so attractive. It could get better. if economic situations get worse, then all of a sudden those prices might look more attractive. I tend to think that Congress providing more explicit funding and relief for states and localities would be extraordinarily important for supporting the American worker and households and businesses, because there are a lot of people employed in state and local governments. And if if the budget cuts have to take place at this ruthless level in order for budgets to be balanced, which is what state and local governments basically have to do, then the employment consequences are just very severe, and that has knock-on effects for the entire economy. So I think it's really a good investment for that. Nonprofits, we have, again, the challenge with the Fed is we're not allowed to provide grants, but the Paycheck Protection Program had that grant component to it. And so we did try to, I know I talked to a number of nonprofits and my colleagues as well, the governors in Washington as well, and we tried to make it to facilitate as best we could their access to the banks so that they could get their application in for the SBA PPP loan. And there were a couple of large nonprofit entities, I think one out of Minneapolis, that was particularly useful for sort of consolidating a lot of these efforts and getting those funds to nonprofits. So I think that's been helpful. It's relatively short-term and modest. Nonprofits, the entire nature of the business is one where they typically have a donor-funded type of situation, and it's just not unusual for them to be challenged and many to go under during deep recessions. And to the extent that we could avoid that, they're a very important part of the safety net, and that's very important during the moment. They would well be worthy of additional support too. Main Street lending program has been, we're working on a design for nonprofits so that they could get access to loans. But again, it's a loan, not a grant.
Great, thank you for that. So this will be our final question. I think a very important one. So which economic statistic would you choose if you could follow just one?
Oh, I really ought to say the Chicago Fed National Activity Index, because we published that, and it is a summary statistic of 85 or more economic indicators. It's performed very well. I would say the unemployment rate. I think the unemployment rate is just, it captures so much of what's going on for the national economy. The components of it spread across states and municipality, metropolitan areas, I think is also useful. I already said early on, when I said, oh, my outlook for the economy, I kind of waved off the GDP numbers because, the third quarter GDP number could be anywhere from 10 to 20%. That's a wide range. Unemployment is a big percentage too at 11.1%, but I kind of think that I might have a better handle on it. I think it's a very good indicator. Your question about underemployment's related to that. It's just the labor market in general, captures so much of what everybody is dealing with, and the state of their economic well-being, good jobs, good wages, better opportunities. That's really important. So, Fed's really been paying attention to that. We want to support that, and we need every other policy player to also be in that game too.
Great. Well, Charles Evans, thank you for a fascinating discussion and conversation. Thank you for spending time with our GIC community. We look forward to hosting you at another GIC conference whenever that can take place, and once we are back to live programming. But we appreciate your time today. Thank you very much, and please be safe.
Thanks very much, Bill. I always enjoy interacting with GIC. The forums are always really terrific, so appreciate it. Thank you.
Thank you. So audience, before we close, just a quick programming note. On July 23rd, next Thursday, we're hosting a conversation about the implications of central bank monetary policy with Stephen Cicchetti of Brandeis University and Paul O'Brien, the former Chief Investment Officer of the Abu Dhabi Investment Authority. That program will be at 4 p.m. Eastern on Thursday, July 23rd. Registration is open. To learn more about GIC membership or ways to support the GIC, please go to the GIC website at www.interdependence.org. And as we conclude, I encourage you to please take 60 seconds to respond to our audience survey. Your feedback is very important to us. Let us know how we can improve the programming. Thank you very much for your attention, and good afternoon.